That's right. They're camouflaging themselves. The credit card companies are after you, folks. Buyer beware. Yeah, here we go. So, JD Power did a little survey, and more than half of U.S. credit card users do not pay their balances in full every month and pay ridiculous amounts of interest. Yes, 51% are carrying a revolving line balance. That means there's no asset backing it up. It's debt. So if you don't think these credit card companies are jacking around with rewards and all these things, here's a couple things. Number one, the money is made when you run your credit card at a business, period. There's something called an interchange transference that happens when those funds move from your credit card, whoever issued the card, the processor puts the money into that bank account and it is gone. That issuer is assessed and is given money on that card that is being used. It's as high as 3.15%, as low as 0.05% on a debit card. And then you start adding rewards. And it's the enticement. Just listen to Dave Ramsey for 5 minutes. It is the enticement of the rewards that causes you to spend anywhere between 10 and 15% more than you would if you were paying cash. Let that sink in. 10 to 15% more could be in your pocket if you weren't using a rewards card. It's pretty crazy. Here's the thing. They say that 46% are considered financially healthy. Now, I don't know what that means, but I know I've talked to enough mortgage lenders in my lifetime to know that they want about 30% of your credit limit, overall credit limit, being used on a monthly basis for you to have the best possible credit rating and credit score. So they want you carrying a 30% balance. So I believe that this number is actually, are they really financially healthy? I don't know. I mean, we pay ours off, God willing, every month. None of our businesses are in debt. But folks, this is huge. If 51% are carrying a revolving line and not able to make the minimum payments, this is called a recession. This is called a house of cards. It is going to come crashing down. And then I can't remember if it was this article. I'm just scanning real quick. There it is. Credit card debt climbs to a record $1.13 trillion. Trillion. So if you don't think that these folks that are issuing these cards are not making a killing, and then when you don't pay off your balance and you're paying 19, 25, 27% on the money, it's a snowball and it compounds itself. Now, why does this matter with insurance? Glad you asked. Because in Nevada, we use what's called insurance scores, and they're a combination of a whole bunch of things, including what? Your credit score. Excuse me just a second. Evidently somebody wants to talk to us on a Saturday, and we'll just reject that one also. Think about that. Your insurance score is affected by your credit in Nevada. So if you're one of those people that's carrying a balance and not paying off your cards every month, and your credit score is going down, your insurance score number is going up. You don't want a high insurance score. It's like golf. You want a low insurance score. The closest to one you can get, that is the most premium that you can be. And the carriers absolutely love people with low insurance scores, at least as far as it goes in Nevada and other states that use an insurance scoring method. And a big portion of that is, you got it, credit score. And if you have high balances on credit cards and you're not paying it off every month, your credit score is going to go down and your insurance score is going to go up, which is going to do what? It's going to cause your auto insurance, your insurance rates to cover your home, your umbrella, your stuff to go up. Because what's the insurance company thinking? Well, are we next when they don't pay? So folks, this credit card stuff has always been close to our hearts, as we've taught Financial Peace University with Ramsey before. Probably need to do it again, considering that $1.3 trillion in credit card debt and 51% of folks that have credit cards are not able to pay off their balances at the end of the month, which is driving up their insurance scores in Nevada, and you're not able to get the best possible rates for your home, auto, and umbrella because your insurance score isn't low. I urge you, figure out your budget. Use the Every Dollar app. Use some app. Use something to budget. Use envelopes. Use cash. But know this, the credit card companies, the What's in Your Wallets, the Chase Sapphire, the Delta, American Express, Rewards Lounges, they want you because they know when you think that you're getting rewards, that you're beating the system. In actuality, you're spending 10 to 15% more every month, even if you're paying off the balances. Why do I know that? I've done it. I know it. I've checked it. It's truth. And on the flip side is if you can get rid of the cards, boy, manage them so that you're not using cards for things that you don't need, so that those insurance scores go down and you're able to get the best possible choices and the best possible rates on your home, auto, and umbrella insurance in Nevada. So hope that helps out. It can also help out on your commercial if you're in a standard market that uses that kind of credit scoring as well. So hopefully this has been a great little tip to help you manage your credit cards, manage your debt, and to pay the lowest possible you can with insurance, making sure that everything is covered as best as you possibly can. So here's to your success, and have a great day.